Hello and welcome everyone, and welcome to BD8 Sterling's webinar, What to Do with Your Australian Super if you live in the UK. Before we start, just some quick T's and C's. This webinar is for information purposes only, so please don't take it as advice at this stage. And all the facts and figures that we've put together for this webinar are based on the rules and regulations as they stand today. So today's presenters is myself, Paul Davis, and my colleague Kevin Tutt. Good
evening.
We're both advisors here in the UK, based in the Epsom office. So just very briefly, just going to go through today's agenda. So we're going to look at today retirement income planning, some pension contribution strategies, the value of advice, reversing the direction, i.e. if you're going to be moving between the UK, Australia and the UK, a little bit about ourselves, BD8 Sterling, and at the end of the presentation there will be a question and answer section, and you should have access to the question and answers box on Zoom. So if you want to drop in any questions at any time during the course of the presentation, please do so, and we'll follow up at the end. So the first section that we go through is retirement and income planning.
Thank you, Paul. Welcome everyone. Before we start giving you any advice at all regarding retirement income planning, we always go back to basics and we find out from the client when and where they're going to retire, whether it's in the UK, whether it's actually in Australia. What do you want to do in retirement? What are your plans, objectives? What are your hobbies, your lifestyle? How does that suit with your retirement? How long will your money last for? You know, most people now potentially with good health could live well into their 90s. So we need to, part of the planning will be that we need to have a sufficient money to last throughout your lifetime. So once we got some sort of basic answers to what someone's retirement looks like and what their aims, aspirations and goals are, then we can start the retirement planning at that stage. Next slide, please, Paul. A big part of retirement planning is cash flow. This really brings to life the retirement plan and puts together your objectives and your desired lifestyle in retirement. So if you've got future expenditure, it could be university fees, new car, holiday home, whatever it might be, we can put that into the forecast planning to ensure that you meet your objectives whilst in retirement. Thank you, Paul. So to achieve that and to help you achieve that, we look at cash flow forecasting. There's a couple of basic graphs on the right-hand side of the screen. The top one, as you will see, has some red bars, which basically means the client is going to run out of money at some point in the future. Ideally, we want the graph to be at the bottom where it's all blue, which basically means the client will not run out of money and they'll have sufficient funds throughout their lifetime. It basically forecasts your future finances, and the biggest question obviously that we need to answer is, do you have enough money to meet your objectives? The cash flow forecasting is based on certain assumptions, so investment growth, inflation rates, and we can also complete some what if scenarios for you. So if someone was going to retire at 65, but actually wanted to say, look at their finances, if they partially retired at 60 and dropped down to say 2.5, 3 days a week, we can look at various options for you. So at least you know what options that you've got and what the finances look like moving forward. Thank you, Paul. I'll now pass you over to Paul for section 2. Thank you.
So in this section, we're going to have a little look at pension contribution strategies, including looking at some of the tax benefits and breaks from contributing to either UK pensions or super. So first of all, both the Australian superannuation regime and the UK pension regime have tax breaks, but they're not aligned. They're not exactly the same. So what you need to consider is when you're contributing, which is the best regime to contribute to and when you need to do it. So the main source of tax relief or tax breaks in the UK is when the money physically goes in, is when you contribute. Both your employer and yourself will get tax relief on contributions as you contribute into UK pensions. You do not get the same level of tax breaks, the same tax breaks when you contribute into an Australian super. However, in Australia, when you come to taking the benefits at preservation age, and if you're resident in Australia when you take those benefits coming out of a super are entirely tax-free. Now, in the UK, there is a limit to how much you can contribute to UK pensions, which is known as the annual allowance. It's recently gone up to 60,000 or pounds, or as whatever your earnings are for that particular tax year, and you can get tax relief on those contributions. Once you've kind of maximised them, you wouldn't be able to contribute anymore unless you're you're using carryback or type arrangements, which is for another presentation. Then and only then, if you have a surplus of income that you want to contribute, you might consider contributing or investing in other vehicles for financial planning, which may include your Australian super, but that would only really be if you consider retiring in Australia, and we'll touch on that later as well. But I think the main thing is for maximum tax efficiency, you can take advantage of the two different systems. So retirement income. So it's very important as you approach or you are entering into retirement, you consider where your income will be coming from. And you might have like various different sources of income that you could take. For example, you might have rental income, you might have ISAs, you might have other sorts of savings other than pensions. Different sources of income will have different tax or tax liabilities attached to them, and it's not always the case where when you come up to retirement that the first source of income that you should always go for is from your pensions or Australian super. Now that seems a little bit counterintuitive because UK personal pensions and Australian superannuation schemes are effectively or have been effectively accumulated for your retirement. So it's usually the first thing people think of, all right, now I should access my pension. But it's not always the case. And when Kevin touched on the cash flow forecasting and strategies, one of the things that we would look at as advisors is which is the best source of income for you to take from your various different products, whether it be UK pensions, super, ISAs, or whatever you might have. So the use of investment tax wrappers is very important. two countries, two different tax regimes, as we've already touched upon, and with that is the different use of investment wrappers at different times. So, for example, if you are resident in the UK, a very tax efficient vehicle to save is ISAs. If after saving in ISAs you move back or move across to Australia, that wrapper doesn't become as tax efficient as it was during your period in the UK. So first of all, you would no longer be able to contribute to an ISA as a non-UK resident, but also the Australian Tax Office treats these types of investments or savings very differently to the UK counterparts. They just don't recognise them. So it's very important that you maximise or look at what you can and can't do now with one eye on any impacts it has on the future. And again, that's where planning and advice around this is crucial. So I'm going to pass you back to Kevin now, who's going to talk about the value of advice. Kevin, you're on mute at the moment.
Do apologise, everyone can hear me now? Good. I talked earlier around financial plan and planning for income. The value of advice, as Paul mentioned previously, is crucial to that plan. We can help define your goals and priorities. The financial plan that we create for someone is very bespoke, very individual to themselves. And once the plan is set up, then we can conduct annual reviews or regular reviews with you to ensure that you're meeting your objectives and the plan is on track. Next slide, please, Paul. Okay, so ensuring tax-efficient withdrawals from your superannuation scheme. BDH Sterling work with a significant number of our clients preparing tax-efficient withdrawal strategies from their Australian super. So if we start with the release conditions, the super provider in Australia will expect you to have two release conditions. Firstly, that you meet your preservation age. If you were born after July 1964, your preservation age will be 60. And if you were born before July 1960, your preservation age will be 55. And it goes up pro rata between 55 and 60 from 1960 to 1964, depending on when you were born. The other condition that you will have to meet is that you would have ceased employment, or you've reached the age of 65. So if you're still working post 65, it doesn't matter. But if you're still working pre 65, you have to cease employment to meet that release condition. So when we look at your superannuation scheme, predominantly it will form in two parts. You'll have a tax-free component and you will have a taxable component. The tax-free component is based on something called foreign service relief, and the taxable component will be accessible to tax via your tax return self-assessment to HMRC. So predominantly the foreign service relief is based on contributions and growth of your superannuation whilst you were in Australia up to the 5th of April 2017. Now, it's important to remember that not everyone qualifies for foreign service relief. You will need to apply to HMRC A specific method of applying is required by HMRC, and us at BDH Sterling can certainly help you with that. And it's best to take advice to ensure you actually qualify, because once you've qualified for foreign service relief and we know the amount of the tax-free component, and then we can proceed with our calculations and recommendations. One thing that's worth knowing is the taxable and the non-taxable component has to be taken at the same time. So if I give you a very quick example, someone had $100,000 in their superannuation fund, they're looking to withdraw. 60% was tax-free and 40% was taxable. So that means that every $10,000 they brought over to the UK, 60% would be tax-free, or $6,000 would be tax-free at that 10,000, and 4,000 would be taxable and accessible to UK tax. So just to summarize on that point, once we've calculated what the tax-free component is and the taxable component, they have to be taken as per with any withdrawal as the same percentages. Finally, be careful of the cure-ops rule. Qualify and recognised overseas pension schemes. If someone was a UK resident, moved to Australia for a number of years and built up a significant amount of their superannuation scheme, they may well have transferred some of their UK pensions into that scheme historically whilst they're working in Australia. If you transferred any UK pensions post April 2006, then they don't qualify for foreign service relief, because HMRC will, in essence, tax them as per a UK pension. So if you have any UK transfers historically paid into your superannuation scheme post April 2006, they will be taxed differently than your main fund within your superannuation scheme. There is something additional which is worth knowing within the cure-ops rule. If you come back to the UK, HMRC, the regulations are you have to take your cure-ops component of your fund first. So the priority of withdrawals is using your UK transfers first, and then the remaining part of your Australian super fund. Now, from a tax efficiency point of view, that's not the best way to take it. So what we would tend to do, and it's always on a case-by-case basis, that we would look to split the withdrawals. So in effect, you'll have two supers, one which is built up from Australia contributions only, and one from your UK transfers. And then we can make withdrawals from each pot as and when in the most tax efficient way. So there's a couple of things that you could get tripped up on, so to speak. So it's very important that you take advice to ensure that firstly you qualify for foreign service relief to maximize your tax-free component, and then when you actually come to withdraw them, especially if you have any UK transfers, we can help to ensure that you take these withdrawals in the most tax efficient way. I'll now pass you back over to Paul. Thank you, Paul.
Thank you, Kevin. So in addition to Kevin's been talking about with regards to withdrawals from superannuation schemes whilst you're UK resident, there's one other thing to consider. And that might be that as an individual, you may qualify for a departing Australian superannuation payment. So that's really if you previously worked and earned super whilst visiting Australia on a temporary resident, you can apply to have your super balance paid to you. Now that can be at any time, regardless of age, but you do have to meet certain conditions, and one of those is having been a temporary resident in Australia and you're no longer resident in Australia. One thing to caveat on that, although it can be paid to you any time, this payment will be subject to tax by the ATO, the Australian Tax Office, and that's quite a large amount of tax that's payable on that. So you really do need to consider whether you wish to take that payment as a departing Australian superannuation payment, or whether you wish to wait until you meet the condition of release. With regards to the departing Australian superannuation payment, we can provide information on that and a link to the government website. We won't be able to provide advice on that in isolation, although we might be able to do it as part of a broader financial plan. So, section 4, reversing the direction. So this is for people who are kind of moving between the UK and Australia, or back to the Australia from the UK. So as mentioned earlier in the presentation, super access is available from age 60 or 65 years of age, depending on meeting the condition of release. One thing that's very important to consider is, whereas a transfer is available from the UK to Australia, a UK pension to an Australian super, the reverse is not true. So if you are a UK resident and you have an Australian super, the only way of accessing that would not be to transfer back to the UK. It'll be wait until you meet those conditions of release and have those benefits paid to you. If you aren't age 60 yet and you don't qualify for the DASP payment that previously mentioned, for those in accumulation phase, it's very important to make sure that your asset allocation is appropriate. So it might be another 20 years before you can access your super, and it's very important to make sure that your funds are suitably invested. Again, that's something that BD8 Sterling can help you with. It might be that when you originally set it up, you were on a certain kind of attitude to risk, you had a certain asset allocation, which might not be appropriate as you get older, or you've built up funds in other areas. As duly qualified and licensed financial planners, both in the UK and Australia, that's something that we can actually help with and provide continuous advice on. And another point is that many people will have or potentially hold kind of life insurance or some sort of insurance within their Aussie super. Again, it's important to understand as to whether that insurance is still appropriate for your needs now, if it still does pay out, and if you've got any other insurances that might supersede that. So it's very important to consider, if you have come to the UK, if you are leaving super for a continuous period back in Australia, that you make sure the assets held in that are still appropriate for your needs. And finally, again, something that we've touched on, or Kevin touched on in previous slide, is if you are UK resident and you are taking income from your Australian super as a UK tax resident, you will be assessed for tax in the UK. But again, there are component parts, including foreign service relief, that we can help make sure that you qualify for. So again, very important to consider is that Australian assets will be subject to access for UK IST if you are UK domiciled. It is best to stay and take super as a tax-free lump sum if you are thinking of moving back to Australia at any point, or you are in Australia and thinking of moving to the UK. Again, this is something we can provide advice around. It's a lot more tax efficient to take your super as an Australian tax resident than it would be as a UK tax resident if the opportunity arises. And that brings us to something that we can help on, or we can help through our accountancy on BDH tax. It's looking at someone's tax status, and if coming up to retirement, or even now, it isn't crucial to you for like a motive or family or job reasons to be living in one country or another, it might be good to kind of look at your options as to what the best location would be for you when you access your super or any other types of pensions or investments. So just a little bit about us before we go into the question and answer section. Why would you use BDH Sterling? Well, we're duly licensed advisors in both the UK and Australia. We have expertise in advising on defined benefit schemes in the UK. You can get this advice all under one roof across our global offices, and we are able to provide advice in financial services on Australian super, tax advice through BDH Tax, who I previously mentioned, and retirement planning. As a company, we've been going for around 15 years now, and some of our advisors have been advising in this area for longer than that. So if you want to chat to a financial advisor, you can drop a kind of email to inquiries@bdhsterling.com, or we're going to drop a link in the chat box as well. And if you are looking for overall financial planning, you can send us an email. And if you just kind of like as well, just to drop us your age and a broad idea of your retirement plan, that would be really useful. So we are on the question and answer section now, and I do note that there are one or two questions already in the box. So Kevin, I don't know if you want to just start having a kind of a read through that.
Yep, certainly. We had a question. Looking at the questions, what is the most tax efficient way of getting my super into the UK? Withdraw all of the super to UK as one large lump sum, or withdraw super on a monthly or regular or annual basis? That's a very good question. It all really depends on the size of the value of the fund and your current tax situation. As broadly speaking, the taxable component of any withdrawal, once that's accessible to UK tax, will be added on to your net income or net relevant income for that particular tax year. So if you didn't need the money, or didn't need a large amount in one go, you probably wouldn't want to withdraw it, because it would mean that it could push you from a basic rate to a high rate tax band. So we would look to recommend to make withdrawals firstly to meet your needs and to meet your circumstances, and so in a tax efficient way. So we would look to make the recommendation where at least it will keep you within the same tax band as you're currently in.
Yeah, so I think the key message there is Kevin, it does depend on each individual's situation. So yeah, it depends at what point you are at retirement, whether you do have other sources of income, have you got any plans to move back to Australia. So there are a few points that we would need to address before we could kind of answer that. It is different for everyone, but yeah, broadly speaking, you're absolutely right, Kevin. We'd have a look depending on someone's personal position and their tax rate. There are a couple of questions that I can cover off quite quickly. First of all, one of the biggest problems that we have sometimes as financial planners is the use of acronyms. So I do have to apologise. So what is IHT? It is in fact inheritance tax. So I know we touched on it in one of the slides. So sorry, I didn't sort of qualify that properly. Next question I have is, what if I plan to retire somewhere else, neither the UK nor Australia? So that is a good question. That would largely depend in terms, again, of what you've accrued either in the UK and Australia. And maybe it would also depend on the double taxation agreement that country would have with either the UK or Australia. So how a pension or a super is taxed is largely down to the country that the individuals lives in and their double taxation agreement with either the UK or Australia. From an Australian super point of view, just to be clear, if you do meet the conditions of release preservation age, then you will just by nature of Australian super, the benefits are paid out tax-free at source. But again, it depends when it's brought into the country of resident other than the UK. And in this particular question, it would depend on what the double taxation agreement is between the UK and that country.
Thank you, Paul. A couple of questions that have come in. Firstly was, if you're looking to retire and make withdrawals from your superannuation and looking to engage with BDH Sterling, how when's the best time to engage with us prior to retirement? I would say probably somewhere within 6 months before retirement. It takes some time for us to contact the superannuation provider to get all the information that we need, do our calculations, our research and analysis, and to actually provide a recommendation. And then once you've accepted that, to go to the superannuation provider, complete the forms and get the money withdrawn. So I would say around about 6 months prior to retiring and making any withdrawals would be sufficient time for BDH to do their work, so there's no delays in you receiving your funds. There was another question that came up was, if I went back to Australia for a short period of time, could I actually withdraw the full amount of my super and then bring it back to the UK? Unfortunately not. HMRC don't really want you to do that, basically. So what they've said is, if you move back to Australia and withdraw your superannuation, the full amounts, if you move back to the UK within 5 tax years, sorry, Paul,
well,
you're going to...
Yes, that'd be the case if you transferred your funds over from it. So if you transferred your funds from a UK pension scheme to an Australian scheme and withdrew from Australian super and came back to the UK, there would be kind of an issue with the UK. If it's funds purely built up in Australia, then it wouldn't be you would be able to withdraw those funds without any problem from HMRC.
Well,
so let's have some of these questions. Will I pay tax on UK private pension if I return from the UK to Oz and transfer the private pension to my super account? So that's a good question. So this kind of is a little bit of a follow-on from what I've just said previously. So if you have a UK private pension, you can transfer it to Australia. You will be there's certain rules that you have to meet. Again, that's a different presentation I think we have and can make available, which is with regards pension transfers to Australia and QROPs. But yes, you can do that, providing you meet certain criteria, and then you can withdraw it from your superannuation account. But that scheme would have to qualify as a qualifying recognised overseas pension scheme before you transfer it across.
One of the very first questions that came in was, what if I plan to retire somewhere else?
Yeah, no, that's fine. We've
Need
covered that one. Yeah, we've covered
okay.
that one. So the next one, how long before? Oh yeah, no, you've covered that one.
Paul, I'll pass this one over to you just because you covered the DASP payments. What if I initially worked in Australia on a temporary visa, but then later obtained a permanent visa and have built up super during both periods?
Yeah, so if you were a permanent visa holder, then you wouldn't qualify for the Department Australian superannuation payment. So that's only for people who were temporary residents, and when they left Australia, they were temporary residents.
Another question we had was, how will the recording be made available on the BDH Sterling website? I know they're normally on YouTube, and they can, and we can actually send those out to the participants. If you particularly wanted a recording or just the slides, we can certainly get that over to you. That's no problem at all. It came through as an anonymous send. If the person just wanted to put another the Q&A with their name, and then certainly we can certainly arrange to get the recording over to you.
Another question, I think just beneath that, very good presentation, thank you. Thanks, Mum, for sending me a question in. Are you suggesting that it might be an option to move to Australia from the UK on a temporary basis, i.e. for tax year, to access super tax-free? I say, so that's quite a big question. I think the main thing to consider is if and there's so many reasons to live in the UK or Australia, and they're not kind of purely around tax, and they wouldn't purely be around accessing super. But if it doesn't make any difference one way or the other, if you're a tax resident in Australia, when you access your super and you meet the preservation age, then the funds will be paid to you according to the Australian legislation. So HMRC doesn't have to have any interest in that.
A couple of questions, Paul. One was, I'm a UK resident, not looking to move back to Australia at all. Can I withdraw my super and bring it over to the UK? Yes, of course, there's no problem at all. HMRC will obviously tax you as per the presentation. The second question was that I picked up. If the whole of my Australian super is in tax-free, can I draw it as tax-free in the UK? That's a good question. There's various components within your superannuation within Australia. So you'll have a tax-free and a taxable. However, that's purely for an Australian resident and the ATO. When you withdraw those components as a UK resident, then they'll be split for you tax-free via the foreign service relief claim and the taxable component. So they're not quite, although they're called the same, then the amounts, there's different components for if you're a UK resident or if you're an Australian resident. I'm just going through some other questions.
I can just go through a couple. I've got one. Do you provide advice on will, estate planning and the taxation implications? So the short answer to that is yes, we can provide some of that financial planning. It may be between us and our other arm to our business BDH tax, but yes, we can provide that.
Oh, there was one question regarding an Australian bank account to receive payments. Again, a very good question. The majority of the super providers that we've used, they will only pay the any withdrawals into an Australian bank account.
I think the key thing with them actually, Kevin, which I've found, there's one quirk, is they can actually pay to a foreign bank account, but only if it accepts in Australian dollar currency.
Okay.
So in the majority, I think the majority of cases, I think you're right, Kevin, they will only pay to an Australian bank account, but in most cases, it's going to be as long as the account or overseas account can accept Australian dollars.
We did have one client, it's a little bit old fashioned. We did have one client where their bank didn't accept foreign currency. So the super provider just basically sent them a check in the post, which is difficult to believe in this day and age, but their bank couldn't accept overseas foreign currency payments. Just going to have a look through some more. What is the situation with state pensions in either country?
Yeah, that's a good question. So if you have built up enough national insurance contributions here in the UK, so minimum 10 years worth, you'll be entitled to at least some of the UK state pension, maximum state pension, if you've been here 35 years. When it comes to moving to Australia, you'd still be entitled to what you built up in the UK as a UK state pension, but any payments made from the UK state pension whilst Australian resident will not actually increase, so that you won't get any like cost of living or indexation on your UK pension if you are an Australian resident whilst receiving it. So you'll still be entitled to it, but you won't get that increase. If you entitled to the Australian age pension, it normally only pays out if you're actually resident in Australia when you claim it. The Australian age pension works slightly different to the UK pension. It's just based on residency. There's no national insurance or any sort of contributions. It's also a means tested benefit. So if you have assets over and above a certain amount, you might not be entitled to that anyway.
Someone's just given me their email address to say, can I please send the slides over to them? So, yep, I've just taken note of that. So I'll ping those over to you. Thank you very much.
So there's a question. Generally speaking, is it more advantageous to be UK resident or Oz resident when it comes to taking pensions? Well, look, it's again, and I can't stress this enough, I wouldn't necessarily plan your whole life around certain things, but if you are looking to retire and take your benefits, it's normally better to take your benefits in Australia from an Australian super, because at preservation age 60 you can get those benefits out tax free. If you're accumulating or building up pension benefits, it's normally better to be UK resident to do that. So as I said before, in one of the earlier slides, you get tax relief on the contributions on the way in when you and your employer contribute to a UK personal pension or UK pension. Funds held within a UK pension grow tax-free. When it comes to retirement in the UK, only 25% comes out tax-free, and the rest is assessable for tax. if you're Australian resident and you're drawing from a UK pension, then you're assessed for tax in Australia on that if you're a permanent resident of Australia. However, in Australia, you don't get the same level of tax relief or the same sort of any sort of tax relief at the contribution stage. You get tax, or there's an element, a taxable element on the growth within your Aussie Super, but again, at preservation age, you can take the benefits out tax-free if you are an Australian resident, meeting the condition of release. So it's very important if you look at kind of the cycles, if you like, the life cycles of the two types of contributions. There's tax relief at the UK end when contributing, and you get your tax benefits at the retirement end of a super when you withdraw your benefits.
We've got quite a few questions around access to the recording or the slides.
Yeah, that will be made available to everyone who's signed on to.
Yes, so you will get copy. There's quite a few questions on that. There's quite a few that we've. Firstly, thank you very much for all the questions that we've had so far. If there's anybody that, as Paul said, would like a more of an in-depth discussion with either myself or Paul in respect of your own personal situation, then please feel free to get in touch, and we can arrange a further call to discuss your requirements in more detail.
Yeah, we've got a few questions with regards to the cost of our service. We do charge on a fixed fee basis, but I'd like to sort of point out that we do an initial chat or consultation, which we can do over the phone, face to face in our office, or over kind of video conferencing, such as Microsoft Teams, and we don't charge for that initial consultation. So at that point, we assess your situation, see which kind of our services are appropriate for you, and then we can tell you the costs and charges of our services in that initial meeting with no obligation to go ahead. So. Okay. I think that's broadly covered all the questions. Really sorry if we haven't got round to some of the questions that have come in, but if you do want, as I say, do you want to kind of drop us a line or drop us an email, we will be able to cover that with you. So that's inquiries@pdhsterling.com. So I hope that you found today's presentation of some benefit, and we will be making the presentation available. It will be coming up soon, I think, on YouTube. And as I said, if you have any further questions, please feel free to inquire. Okay. So thank you very much for joining us today.
Thank you very much.